You're welcome to my channel. In this video we are going to be looking at capital gains tax. So capital gains tax, as you hear it, capital and then gains, it has to do with assets and then profits. So it's like the tax that is imposed on the profits made on selling business assets. Yeah, so it's what we are going to be looking at in this video and in the upcoming videos. So we shall start with the definition. Capital gains tax is a direct tax on capital gains arising from the disposal of a qualifying business asset. So whenever they sell off a business asset, the gains earned from selling or from disposing of that asset are taxed, and that tax is called the capital gains tax or CGT. Yeah, so let's define business assets. What are business assets? Business assets are also known as the non-depreciable assets. Remember, we have assets that depreciate and those that do not depreciate. So those that do not depreciate are the ones we refer to as business assets. So these are assets that are used in a business and they do not lose value over time due to wear and tear. And examples we have is land and buildings. Land and buildings excluding industrial buildings. So if a business sells land or an office building, which is not a factory, any profit made is subject to capital gains tax. For example, if a company buys land at 50 million UGX and they later sell it at 80 million UGX, that difference of 30 million is the profit, and that profit is taxable. On that profit is where they incur the capital gains tax. Then another business asset we have is the portfolio investment. So portfolio investment assets include things like shares and securities. So if a business buys shares for 10 million and they sell them for 15 million, that difference of 5 million, that gain, is subject to capital gains tax. Then we also have intangible assets, the non-physical business assets like the patents, the copyrights, and partnership interests. They are also subject to capital gains tax. So if a company sells a patent for 20 million after acquiring it at 5 million, that gain of 15 million is subject to capital gains tax. Yeah, so that is like a brief introduction of capital gains tax. It's a direct tax on the capital gains arising from the disposal of a qualifying business asset. And business assets are those non-depreciable assets that are not subject to wear and tear. Let's look at the exclusions from business assets, the assets that are not subject to capital gains tax or CGT. So the first one we have is trading stock. And these are items a business buys and sells regularly, like the inventory or the stock of the business. It is just stock they buy and sell, so it's not subject to capital gains tax. So that profit that they make from selling that daily stock can't be subject to capital gains tax. Then secondly, we have depreciable assets. So assets that lose value over time due to usage, passage of time, such as machinery, vehicles, furniture, are not subject to capital gains tax. So for example, a company selling an old delivery truck is not taxed under CGT. Then we have industrial buildings. For example, factories and warehouses, they are excluded from capital gains tax. For example, a manufacturing company selling its factory building is not subject to capital gains tax. Yeah. Then let's look at the gains and losses on the disposal of assets. So again, obviously, it's when a profit is made. It's when the disposal price exceeds the cost base of the asset. Yeah, so if a business buys land for 100 m and they sell it for 150 m, the profit of 50 is a capital gain. Yeah, so it's where the disposal price or the selling price exceeds the cost price of the asset. Then loss is the opposite. It's when the cost base exceeds the disposal price. Yeah, so we also have a term called cost base. Cost base, in simple terms, it can be the cost price. So this is like the amount incurred to acquire an asset, including all the incidental capital expenditure or the market value of any consideration in kind. So cost base is like the total amount spent to acquire an asset, including those extra costs like the legal fees, the taxes, etc. Yeah. So we are going to be looking at the computation of capital gains tax, but in the next videos, capital gains are taxed at 30% as part of business income.